Another milestone on Wall Street today, but not a good one. The Dow posted its worst weekly decline for 2013. And it wasn't only the blue chips struggling. It was a lousy week for most of the major stock indexes. They closed in the red for the second week in a row. What continues to nag investors is conflicting reports about the economy, like today's news. A closely watched consumer sentiment survey fell sharply, but there were some strong numbers from housing, and we'll have more on that in just a moment. So investors played it safe and sold stocks. The Dow lost 30 points, the Nasdaq slipped 3, and the S&P off 5.5 points. Looking at the week, the Dow and S&P tumbled 2%, and the Nasdaq was down by 1.5%. Meanwhile, in the bond market, the yield on the 10-year Treasury note spiked, hitting its highest level in 2 years.
So with stocks taking a tumble this week after shooting higher since the start of the year, the big question is this the full-fledged correction that so many on Wall Street have been predicting? Jackie DeAngelis looks at the evidence, pro and con.
The bears have one-upped the bulls this week on Wall Street, leaving most of the 10 S&P large-cap sectors in the red, and the few that aren't are barely positive. This trend raising some eyebrows on Wall Street with the concern that the long-awaited correction may be taking shape. Here's Jeremy Siegel of the Wharton School of Business.
Past August, obviously a 10% correction is certainly in the realm of possibility.
The worst performers, industrials, materials, and financials. The best of the worst include healthcare, the consumer discretionary group, and consumer staples. Many analysts and market observers have been calling for a correction for some time, but haven't been able to get the timing quite right, as the Fed has been able to keep the market momentum moving, and that has the bulls saying that this is just another bump in the road.
But what's happening now is a little different, especially as the yield on the 10-year rises, hitting levels not seen in 2 years. If the Fed backs off its bond buying program and yields continue to rise, it could have a more significant chilling effect on the market, especially on defensive sectors that are more sensitive to moves in interest rates.
McNeil Curry, the head of technical strategy for Bank of America Merrill Lynch, tells me that as rates push higher, so does the anxiety on the street.
Definitely it is the push higher in interest rates is leading to a little bit of increased anxiety in equities and obviously forcing them to correct a bit to the downside.
This leaves a lot of people asking, if the markets are correcting, how big of a move will it be? Only time, of course, will tell. For Nightly Business Report, I'm Jackie DeAngelis.